Right, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today we've got a very exciting update for you. And the update that I've put together for you guys is an update on Qudian, or for all my Guaylo friends who can't speak Mandarin, you can just call it Qudian. So back in May, I had initially covered the stock, and in my initial analysis, I had said that it was poorly priced and the market doesn't really understand the business, and therefore there should be an 80% upside based on my research. When I made the video, I was a little bit too conservative and too light on my valuation, so hence the reason for today's updated video. So the first reason is I believe that my initial valuation was a little bit too conservative, and following further research, since then, I've decided to update my amended valuation. And then the second reason is because one of my subscribers, shout out to you, Valentin, he basically wanted me to make a follow-up video to have a look at comparing Qudian versus their listed peers, right? So your year-end dies, your PP dies, all of that other stuff. And then what I believe are the competitive advantages and why I like Qudian more than the others. So what we're going to cover today is, first of all, Qudian versus its micro-lending peers, and then my updated valuation and target price analysis for Qudian. Okay, guys, so let's get into it. So very quickly, I just wanted to take you guys through the last quarter's numbers, okay? So as you guys can see over here, we've got Qudian, PPDI, Gen something technologies, can't remember, Chinese Rapid Finance, and then year-end die. So I've compared Q4 2018 and Q1 2019. Now, a lot of the information that I was wanting wasn't available, so this was the information that I put together to the best of my ability through what was disclosed in the various calls and the earnings call transcripts. And so a couple of things immediately stand out, okay? And here are the few things that I wanted to point out. So first of all, Jianpu Technologies, okay? So they make good revenue, but their sales and marketing expenses are absolutely massive. So the reason why I don't like this is, and what this tells me, is that the company has to grow traffic and grow users and grow revenue very inorganically, right? So people don't just come to their platform, they come because of a call to action. And so long term, as you guys can tell by their margins, very, very slim, right? So they're operating in net margins. So for me, this is a red flag for me, and that's why I'm not interested in this company. Okay, now XRF, China Rapid Finance, basically, I think it's a very dodgy company because they haven't even got their Q4 or 20F annual report up, and they don't even have their Q1 report up, and it's about 7 months late, okay? So this is, again, a huge red flag for me, so a big no-no. Year-end die, so pretty good company, but if we focus on where they get their funds from, there is still a large portion of their funds that they get from people, right? So they're still operating as a peer-to-peer lender. And if we remember back to the previous video, Qudian doesn't do that anymore because all of its funding partners are basically institutions or banks, okay? So there's literally no more P2P lending in Qudian, whereas with year-end die there is. And so as a result, if we again go back and look, okay, delinquency rates, pretty high, right? Margins are pretty low. Operating margins are low, and you can say, well, net margins are pretty good, but that's because they've did some sort of creative accounting, recognized some other non-operating net income. And again, so this is a reason why I don't like it, okay? Because as you guys may recall from the previous video about Qudian, ever since the crackdown, the Chinese government has heavily cracked down onto the P2P lending industry, okay? And that's why Qudian changed their business model and are still growing and very nimble. And anything that has a P2P aspect in terms of micro-lending, I'm not a fan of. Qudian's margins will remain high because they don't lend anything, right? The institutions lend, the institutions take a cut, Qudian get paid, okay? These guys lend, but then they have to pay their investors a handsome return, otherwise their funding source will go away, year-end die, if they don't pay their investors a handsome return, and then they'll go elsewhere. So again, that's another reason why I don't like them. So you guys can see, okay, well, what about PPDI, okay, PPDF? They're pretty good margins, nice sort of similar loan size to Qudian, and I would agree, okay, this company's not bad. But again, In my opinion, they're only second best, because if we look at the delinquency rates, okay, 6.5% versus sort of 2-3% on Qudian, and then the repeat borrowers, okay, so this is the very important thing. So repeat borrowers in Qudian, high 80s, low 90s, whereas for all the others, it's either very, very low or non-existent or in their 70s. And so this is another reason, because I think moving forward, Qudian will be the most profitable and most sustainable about these, because their customers are happy, they come back, they've got very low marketing costs, so that helps their margins. And it's important to remember the cost of winning a new customer versus the cost of keeping an existing customer is 3 to 1. Okay, guys? So it's far more expensive to win new customers. All right, guys, so moving on. What do I believe is the core advantage of Qudian versus all their peers? And I can answer this question for you in one word, and quite simply, it's data, okay? So Qudian's data is what I believe sets them apart from any other microlender, not just in China, but in the world. And the reason why is because they have accumulated over 185 million transactions since 2014, worth 201 billion RMB in terms of value, okay? So what is this data? Okay, so this is how people borrow, why people borrow, when people borrow, how much do they borrow, when do they repay, who can't repay, why can't they repay, how much can they repay, if they can't repay, do they not repay all of it, or do they not repay some of it? If they can't repay, when can we get it back? All of this information, this is highly, highly, highly valuable information, okay? And because their data analytics and AI is so powerful, they can use basically the system to approve within seconds whether somebody is rejected or approved for a loan, how much they can borrow in terms of their maximum credit limit approval, and all of this other stuff, okay? And if any of you guys have worked in finance before, you'll know that the two riskiest things if you're running a finance company is, first, if you have a really shit quality customer who borrows a lot and doesn't pay, you have to have a lot of write-off, okay? That's terrible. The second thing is that if you have a lot of data and you cannot efficiently analyze the data, then you don't actually know how much to lend to this person, or whether or not to lend to this person, or whether or not continuing to lend to this person, and etc. And so then you'll have to get people to then manually go in and assess this data. Again, very, very costly, okay? And so this is why I think that Qudian has such a massive advantage. Their analytics are very, very, I guess you can say, leading edge in terms of technical capabilities, and they have very low cost, okay? They see a borrower with no credit history, they run their data analytics, and like I said, they can spit out within seconds whether this person should get a loan, and if so, how much, if not, why not, okay? And this is very, very valuable to greedy institutions like the banks, who want to get their hands on this data to be able to lend much larger amounts without inputting a lot of operating costs in order to understand who are the right people to lend to, okay? And so this is why I think Qudian has the greatest advantage out of all their peers. They are one of, if not the lowest cost operators in the sector. It is very, very hard to lend at a very high interest rate of 36%, okay? So think about this for a second. Despite having such a high interest rate, it is very hard for companies to turn a profit lending small amounts of, RMB 1,400, 2,000, 3,000, 4,000, okay? So let's think about that for a second. But Qudian can, because of their precision, they're able to leverage that data and precisely pinpoint who and when to lend to and how much they can make. So again, this is another reason why I think they have such a powerful business model. So looking at all of their earnings calls from when they first listed in 2017 until today, I've basically done all of the heavy lifting and donkey work for you to have an understanding of what are some of the key themes, okay? And consistently, I've been able to pick up these key themes. We as a company have been too conservative. We can increase the volume and the amount that we lend to our customers and increase the term without very little risk profile to us. We have too much demand. We are too popular. Our sales and marketing expenses are, down 40% year on year, but yet we still have people coming through our doors. We have to turn away too many users because if too many people want credit. We just have too many users, and we can't even service them. Okay, so we've got 73 million users, and we have to turn away a lot of them. Out of the 73 million users, 29 million people are approved for credit, but we as a company can only service about 5 or 6 million of them. Okay, and before we were only lending them about sort of 3,000 RMB as an average balance. We can safely grow that to 6,000 RMB and not take on too much risk credit profile. We've just signed on board 19 new institutional funding partners because everybody wants to work with us because our data is so competitive and compelling. This is the general theme of what I got after reading through 100 plus pages of all of their earnings calls. So guys, at this point you might be asking, okay, well, this is great, but what does all this information mean, and how is that relevant to your analysis of Qudian? And the answer is basically simple. Okay, so let's have a look at these three passages and dissect why. Okay, so right now their loan balance per borrower hovers around 4,000 RMB per borrower. They can increase that by 50% without adding too much risk to their credit profile. A lot of their peers are lending a larger amount than them, and they have been too conservative. Most of their growth won't actually come from their existing user base by increasing the amount lent, but it'll actually come from all of this data. Okay, so all of these people who want to borrow but they can't serve. So let's look at the middle of the page and focus on this paragraph. From the time that they launched their open platform, which was 2 quarters ago, they have referred 2.5 million users to other sources, and they have referred 160,000 transactions. Okay, so that's the credit already assessed, the risk already assessed, the report already written, ready to go, but they just don't have the capacity to serve. Basically free money at no risk, because these transactions, they refer to other people lend to these people, and then Qudian get a cut. So no risk to them at all in any way, shape, or form. This is the key thing that we need to focus on, right? So in Q1 alone, they referred 1.8 billion RMB in terms of loan volume at an average ticket size of 8,000, which is significantly bigger than their existing ticket size. And so if we do some calculations and take this into consideration, okay, I think that this is a hugely underappreciated point that the market still hasn't quite yet woken up to. So let's have a think about what this means, okay? So let's do the numbers. They have about 29.1 million approved borrowers, and currently they only have the capacity to serve 5.4 to 6 million. That leaves about 23 million that are credit approved by very, very accurate data analytics and AI that are just sitting there wanting to do business, but they can't. Let's look at some facts below, okay? So again, through reading about 100 odd pages of all of their earnings call transcripts, this is what I've understood. So for their referral business, currently the average ticket size is 8,000 RMB per transaction, okay? The take rates are 5 to 10%. So their take rate basically is their net profit, okay? So how much money can they rake in net income from referring these transactions? And so the Q1 referred loan value was about 1.8 billion. So let's say that of the 23 million borrowers that they're not currently serving, they can refer 5 to 6 million of these people at an 8,000 RMB loan value at a take rate of 5 to 10%. Okay, so again, very small portion, only a quarter of the 23 million who are already approved that want to do business but aren't being served. So as you guys can see over here, I've put together some numbers for you. Okay, I've put together the borrowers, 5, 5.25, 5.5, 5.75, 6 million. The take rates, so 0.5, 0.75, 5%, 7.5%, and 10%. And the additional loan book amount, and then the anticipated additional net profit after tax in RMB as a result of this referral service, okay? Now, if we think about what their current projected financial year 19 net income is, it's 4.5 billion RMB. At the very minimum, if we refer 5 million borrowers, we're effectively going to increase their net income by about 50%, okay? And at the very maximum, we're talking doubling their net income. So again, I think that this is absolutely massive, and this is something that the market hasn't appreciated. So in 1 quarter alone, they referred $1.8 billion of loan value, and their current loan book is about 30 billion renminbi, not dollars. In one quarter, they managed to do 5% of their entire loan book since launching the platform of referral business. So let's just stop and think about that for a second and what the significance of that is. Let's move on from here and do an intrinsic value calculation for Qudian, but let's not actually use the referral business. Let's just use everything that we know for certain is happening today. So back in June, Qudian raised their total net income guidance from 3.5 billion RMB to 4.5 billion. Okay, massive. That's 30 odd percent. And their previous year they did 2.5 billion RMB. So again, guys, I've put together for you their margins, gross margins, operating margins, net margins, market cap, number of shares outstanding, the exchange rate, their previous net profit, EPS. I've put together all of that for you, okay? So let's take their current 4.5 billion RMB net income. If we break it down, that comes to an EPS of $2.18 American, USD. Now, let's just apply a conservative 10 to 12 PE ratio to that, okay? We're looking at about $21.77 to $26.13. And so let's take this growth rate for the next year and project that into FY20, okay? And I'm going to take 30 to 50% net income growth rate. And you guys might be thinking, okay, this is very, very, it's probably a bit too bullish, okay? And I've got my reasons why, and I'll share that with you later, okay? But let's have a look at that and see what that means, okay? So let's say if they manage to get, 5.85 to 6.3 billion RMB, okay? Let's just be conservative and use 30 to 40% net income growth. We're looking at an intrinsic value at a PE of 10 or 12 of $28.31 to $33.97, okay, guys? So now I'm going to explain to you why I'm so bullish that they can grow their net income by 30 to 40% at least for the next year, okay? So are you sure? And the answer is I'm pretty sure. And the reason being is, again, if we dive into their call notes from the second quarter of FY18, they have stated that based on their current user base, they believe that there is a sustainable long-term growth rate of anywhere from 30 to 50% for the foreseeable few years in terms of the bottom line. Furthermore, they don't foresee growing their sales and marketing expenses at least until 2020, but can still deliver the numbers as well in the guidance. Even furthermore, if we look at line 87, they have just added another 10 billion to their loan book on top of their 24.6 billion, okay? So that makes it about 35 billion RMB. But in order to get the guidance, all they needed was 30 billion. Their take rate for their non-referral business, their own business, is 13 to 15%. So let's just think about all of this for a second. So their sales and marketing expenses are massively low, like we covered in the previous video. Even after they lost their Alipay relationship, they still managed to grow their income, user base, whatnot. As we saw earlier in this video, the theme throughout their call notes, their earnings call transcripts, were we just have too many users, we're being too conservative, we have to turn a lot of users away, okay? All they have to do is just lift the dial a little bit and then be a little bit less conservative, and bam, you've got a lot more growth, okay? So give them a bit more money, give some approved users a loan, okay? Not very hard to do. So again, guys, this is why I'm so bullish on this company. Okay, guys, so let's look at these few things, okay? I wanted to take you through these 3 pieces of information below to see why I believe that Qudian will re-rate to about a 10 to 12 PE ratio, okay, and why I believe that they're going to slowly diverge away from the industry. So this is a comment from their CFO from the March 18 conference call for Q4. And they genuinely believe that Qudian is still being wrongly lumped in with all of the other P2P lending players. I don't think the market has woken up to the fact that they aren't a P2P lender anymore. They're basically a facilitator of data and information for institutional lenders and regulated banks who want to lend at a high interest rate. As a result, I believe that they have still been sold off along with every other lender. So let's look at these 2 graphs below. However, I think that the savvy investors in the market is slowly starting to wake up to Qudian actually being a different company. Before too long, they would have fully woken up and re-rated this company to my intrinsic value before. Okay, so let's look at them versus their 5 listed peers. Okay, now have a look at the way that the share price is tracking. So you can see the trajectory of their share price looks very, very similar to their peers until over here, as I've circled for you, it started to diverge away from the trend. Okay, so all the other peers are kind of like this and then in a slow downtrend, but Qdian has started to go on an uptrend. And the second thing I wanted to show you is if we have a look at the PE ratios. Again, very similar to their peers, the PE ratios have followed a pretty similar trajectory until, as you guys can see over here, they've started to diverge away from that. So whilst their peers are either going like this or going down, you can see the Qdian PE ratio slowly starting to go up. So I genuinely believe that this is a sign that the market is slowly starting to wake up to this company. Let's just revisit the information that I've looked at before. The entire micro-lending industry, this is still in its infancy. And so we have limited information to work with, and again, so that makes projecting their intrinsic value a little bit harder than, maybe somebody that's been around for 5, 10, 20 years. So with the limited information that I've got, after they had the massive drop, there was a period where they kind of stayed sideways for about a quarter before continuing to drop after they lost their hourly pay relationship. And based on my calculations, the market was quite happy to pay about a 10 to 12 PE ratio. Furthermore, I had a look at the oldest company of the bunch in terms of the micro lenders, Year and Die. So they've been around for 3-4 years. And again, as you guys can see, if we look at the share price fluctuation and we sort of discount any major shocks or major news, you can see the market's sort of quite happy paying about a 10 to 12 earnings multiple for this company as well. And so as a result, this is how I derived my intrinsic valuation in terms of a re-rate and an earnings multiple 10 to 12, okay? And keeping in mind, I'm just using limited information for this young industry. My target upside is about 200 to 300% in the next 18 to 24 months. Having said that, I think it's really important to remind you guys that none of what you see on this channel or this video, for that matter, should be construed as financial advice. And before you guys buy anything or invest in anything, you should always do your own research and consult a qualified expert. Okay, guys, so that concludes the video. I hope you enjoyed watching this, and really looking forward to your feedback. If you're enjoying these types of videos and enjoy deep analysis into companies and talk about and think about things that people aren't thinking and talking about, then make sure you hit the like button, subscribe, leave a comment, and share the video. Until next time, happy investing.